We are live. U.S. wants war with Russia. Buy this portfolio now. This is a $10,000 trade alert for our high risk strategy, which is what we're recommending to investors on a free trial with Portfolio Builder. So let me walk you through the current trade recommendation, and then we'll go through what our expectations are for return in 2022. Step one, buy 89 shares of UVXY. This is trading around 1262 a share. We call this the crash insurance. If we get a complete meltdown in equities, which would probably be due to most likely the inflation being a lot stickier than I'm personally thinking at this point, we want to have that crash insurance play right there with UVXY. We've also had Putin threaten nuclear war if NATO doesn't stop taking over Ukraine. So that I would say is far, far less likely. But there's always reasons to have crash insurance in your portfolio. Now, in 2020, when the whole world locked down, this position went up 1,100% in less than 4 weeks, completely protecting your portfolio against all downside risks. Our clients have this in the portfolio at all times. Regardless of how risky we think the market is, we always have it in there because it protects us against black swan events. Step two, pick up 222 shares of the Grayscale Trust ETHE. That's Ethereum. This is the asset that is replacing the US financial system. They are ripping off every little last piece of the US banking and financial system, from insurance to loan origination to stock trading houses, you name it. Ethereum has replaced it with far more efficient technology. It's a beautiful product where we see the most growth in this coming decade. Pick up 222 shares at 26.35. Here's a look at that chart. And we just had a huge sell-off in ETHE, about a 55% retracement. And we've been telling you to buy the dip and sit back. We do see this breaking into new highs in 2022. Finally, the biggest threat to markets is currently inflation. We made our investors a lot of money in ticker NRGU, betting that oil would go sky high. And that oil is staying at elevated prices, along with just about every other futures products, such as copper, lumber, nickel, steel, you name it. Everything is trading at nose bleeding prices. We're betting on natural gas as your best way to hedge against too much inflation and simultaneously conflict with NATO against Russia over Ukraine. Which I think is going to hit a boiling point, no pun intended, towards the end of the month. We've already seen oil double and come back down on us. And I know investors wanted us to pull a quick profit on that, but the fireworks really haven't begun. And we're going to be looking at the lowest inventory levels typically around March. So this really is going to be very exciting as we approach the month end. Now here's that Boyle chart, and we can see just in September and October, it traded at 100. Today it's at 29. We saw it rise as the conflict was getting more aggravated. And then we had French President Macron come over, talk to Putin, and say they'd made a deal. Then Putin said there's no deal quickly thereafter. So this is a fast developing scene. But in general, this is the ultimate inflation hedge in the short term for our high risk portfolio, and we remain long. Here's a breakdown of your asset allocation in a chart format. You'll have this in your email. Right now, we have about 11% of the portfolio in the crash insurance, UVXY. Total cost on that is $1,124. Next, we have the growth position at 58% of the portfolio. I'm actually expecting inflation to slow down, peak in March, which is the 2-year anniversary of oil going negative, and to fall into the rest of the year, which means all this talk of 6, 7, 8 rate hikes could be overdone, and we might be seeing peak interest rates in the short term. So we'll talk about that and more with the very critical CPI print coming out tomorrow. Meanwhile, we have the inflation hedge, which is long natural gas with oil, and that's currently at 30% of the portfolio. This is the perfect setup for how I'd like investors to be situated ahead of tomorrow's CPI and what I'm expecting to be peak inflation by March, falling into April. Now, our high risk return portfolio did generate a total return of 233% in 2021, turning every $10,000 into $33,000. And we just don't touch that portfolio very often. It's very passive and slow moving. So, are you ready to triple your money? If so, make sure to follow our trade alert and get your money in the markets right now. The global economy is slowing down. I expect inflation to peak by March. The government's telling us it's going to peak tomorrow. However, I would suspect it will stay elevated and rising until March and fall into April. This means markets are way off guard, expecting inflation to never stop and for the Fed to be forced into the fastest pace of rate hikes in history, as it is extremely behind the curve. And we're starting to see the data. Global shipping rates are falling, inventory levels are building, and consumer sales are falling as well. So I do believe CPI's Thursday may show a relative slowdown in inflation and be very bullish for our Ethereum position specifically. And so perhaps market participants already know this data as we're seeing a big run up in Ethereum as we speak. We're also starting to see one of the more important sectors, the used car sector, finally starting to slow down as well. So it does look like we will have the inflation rising through March, but topping out and then falling. And so we're more interested in the rate of change of inflation than anything else, because this will impact bond markets and, of course, the rest of our assets. Let's take a look at the key macro events ahead. NATO, Russia, Ukraine conflict may escalate soon. We certainly had a bit of a peace deal in the last 5 trading days, with France coming over there to save the day. But this is not resolved in any shape or form. And when we look at the intel briefings from the US, they're putting out all sorts of fear-mongering news that there's going to be an imminent attack, and we're preparing to evacuate Ukraine of all US citizens. So we like the natural gas play heading to March, just due to the energy crisis alone. We throw in some sort of US-Russia conflict, and oil could go skyrocketing to the upside. So it's really a double whammy. Another important fact is that Congress has increased the debt ceiling by $2.5 trillion. This is perhaps the single most important macro factor on how we're going to be investing capital. And essentially, I believe at the end of the day, as the CPI falls, they will figure out how to spend the money. And we're already spending at a rapid pace without any new bills. So expect more spending after the CPI cools off. And I think that's going to begin in April and May. So we'll keep a close eye on the CPA data. So again, cash is trash. Governments globally are devaluing their currencies, and bonds are still garbage. We've had a big sell-off in bonds in the last several weeks, which has created volatility in markets. And I think in the short term, this is going to calm down and reverse. And again, if interest rates are going to flatline and fall, I want to be betting on tech. Specifically, I like Ethereum. Now, we've made our clients a lot of money in bonds, and there's very few years where bonds don't generate a positive return over the last several decades. But the fact is this, the CPI is at 7%, and the 30-year is only at 2.2. My expectation is the 30-year will rise to 2.5 to 3%, top out, and the CPI will fall to about the same level. And that's when I'll get our clients long bonds once again. But at this point, there's a huge, huge gap and a negative real return of over negative 4%. So investors simply have no other logical option. They can fly out of stocks and have volatility, but once they look at where to place that capital, uh, bonds are not attractive, cash is not attractive. So it really focuses capital into stocks, cryptocurrencies, commodities. And this is likely to continue melting up until the bond market becomes too attractive, which again is when inflation comes in line with interest rates. And again, they're still significantly far off. It's very important that you watch our webinar every Monday, Wednesday, Friday to be ready for sell alerts. So just because you got the buy alert doesn't mean you're going to know when to sell and take profits. And that's why it's critical you upgrade your free trial by calling Dean and taking advantage of the 3 spots available. So call Dean right now at 505-322-7515. Okay, so let's take a quick look at our strategies. Our Safe Growth program, which is designed to funnel profits out of high risk. This is targeting a 25% annual return. It's currently made a 1.5% return in January and is down 2.7% in February. It's a global stock portfolio that diversifies capital into Europe, Asia, and North America while hedging against inflation with several different inflationary plays. So this is designed on the Ray Dalio strategy and is currently overweight Asia because over this cycle, we're expecting interest rates to rise, the dollar to fall, and for essentially China to outperform. The high risk portfolio, which did a 9.9% return in January, is down 4.8% in February. It had a positive return, but Boyle pulled back on us so quickly. We're not worried about that. I still think we're going to see far higher prints on Boyle as we approach the month end. Now, in general, we're recommending investors go 70% in the safe growth strategy and 30% in the high risk. And if the high risk doubles, you should be cutting that position in half and funneling it into the safe growth strategy for safer long-term gains. Now, also, when you upgrade, you're going to gain access to our membership area where you can print trade alerts on demand. And so all you got to do is punch in how much money you want to invest and then hit calculate, and it will automatically design your portfolio on demand. You have the safe growth strategy, and then you have the high risk strategy. So we'll be coming back to the exact asset allocation formulas towards the end of this presentation. Okay, so let's look at some data here. And we're going to start off with my news feed just to get some topical content, and then we can go into charts and economic data. Okay, so here's a look at the 2007 to 2008 crash, which was led with interest rates rising, which eventually led to a real estate crash and then a stock market banking crisis. And so what we can see in this chart is oil is quickly becoming a political problem for markets. And all of our indicators are telling us that, as well as fundamental data, is that the energy crisis is about to get far worse. We're going to start seeing governments attempt to intervene in this, but with mandates getting thrown out the window due to polling going horribly poor for primarily blue states with lots of mandates, get ready for energy demand to become a significant problem this year. So we can see in the last run-up, we had $150 oil, which marked the top in the markets. Today, we're at 92, and there's really no solution in sight outside of political intervention to slow this down. So get excited for Boyle. We'll look at that correlation to oil soon. Okay, it does look like the supply chains are starting to have peaked. We still have China with a zero COVID policy, which it seems they're going to do for the rest of the year. But it looks like the inflation is starting to peak. This will be very important for how we position our portfolio. Now, the White House says tomorrow's inflation data to show a high year-on-year figure, and but remember, last week they told us the jobs report was going to be negative, and it came out positive. Now that jobs data was uh, very, very odd. They have gone back and changed all the numbers for several years, and so I think it's not very good to look at that data. We could spend more time on that. But the next few months, I am expecting job growth to come online as mandates are now getting thrown out. Zero Hedge says 8 of the last 10 CPI prints have beat expectations. So we'll see how it comes out tomorrow. And specifically, let's just look at that CPI. So what I'm interested in is the jump tomorrow. So in the last 3 months, we saw it go from 4 to 4.6, from 4.6 to 4.9, which is a slowdown, and then it jumped back to 5.5. Now they have changed the inflation data in terms of how they're comparing it to actually potentially have a higher print tomorrow based on using the prices from the lockdown period. So this will be very interesting. My expectation, as long as the CPI is below 6.1, that the trends we're seeing in the market currently will continue. But if it is much greater than 6 to 6.1, the anticipation of the Fed having to speed up rate hikes could negatively impact bond markets and then start creating selling pressure once again, probably targeting the NASDAQ. So if it's below 6, we're probably going to have a outright melt up in inflationary assets, expecting that the Fed can slow down these rate hikes. And so that's our expectations of what the CPI might print and how the markets may respond. Crude inventories are at very low levels, and we are ending mandates globally. Okay, so the energy crisis is about to become very problematic. South Korea drops vaunted test and trace strategy in the face of record high cases. Now we've got Canada dropping mandates. We've got all sorts of blue states starting to talk about ending mandates. New York removing mandates. So it's happening very, very quickly. Now this is interesting from Goldman Sachs on the inflation talk relative to wage price pressure. In January, they said there was very little signs of a wage price spiral. And now in February, we're already in the middle of a wage price spiral. So this is one of those sticky items. Energy, wages, and rent could continue to drive that CPI high. So we're going to keep a close eye on that. Savan Henrik says, let inflation run hot, talk markets down with hawkish jawboning, see rate hike expectations fly to the moon, talk expectations down, and see the market rally. Voila, inflation solved without raising rates. So that's essentially what we have seen so far. And again, now we need the CPI to actually slow down. Otherwise, I do anticipate very aggressive rate hikes starting in March. New York statewide mask or V mandate to be lifted tomorrow. We have seen a bit of a sell-off in the high-yield corporate bond ETF. We'll take a look at that. People have been comparing it to the SPY. But if we're right and inflation's peaking, rates are about to stabilize and fall. So not super worried about that. Nomura, blue states are ending COVID restrictions, capitulating by the day in a pure midterm election polling panic. Okay, so it's going to drive energy costs up, as well as recover labor markets. So more pressure for rates to rise, which we're extremely hedged against over the course of time in the safe growth strategy via emerging markets. Alberta ends the passport program effective midnight tonight due to the truck protests in Canada. Breaking, Emmanuel Macron says he convinced Vladimir Putin to not escalate in Ukraine. Of course, once he went home, Russia was joking that that was not the case at all. So that conflict just is not over yet. We'll look at the trade deficit growing month over month in the data in a minute. This is a chart of gas imports from Russia. You can see just how much power Russia will have as natural gas inventories tend to hit a low towards the end of February. So if they're going to make a move, they'll have the most leverage towards the end of February. The long view says don't look, but several emerging market PMIs are already dipping below 50 as China slows and massive rate hikes to curtail inflation start to bite. Uniswap, total value locked, casually printing at a new high with Ethereum still 40% off its high. This is a DeFi exchange, which is essentially a ripoff of Coinbase, another success example out of Ethereum. Kremlin denies Putin told Macron there will be no new maneuvers near Ukraine. Biden, if Russia invades, that means tanks or troops crossing the border of Ukraine again, then there will be no longer a Nord Stream 2 deal. We will bring an end to it. And then Zero Hedge comments that natural gas will hit 4 digits. Reminder that Russia invaded Georgia during the Olympics, to which the Chinese even admired Putin on the timing. Jim Bianco says the market now has 6 hikes priced in over 7 FOMC meetings remaining in 2022. Also note the market has 5 hikes priced in for the next 5 meetings, and the probability of a 50 basis point hike in March is 29%. Live Monitor says Biden is setting Russia up to be a scapegoat for higher oil prices and why the market corrects a bit in the coming month. Irresponsible rhetoric and amateur move, allowing Fed to buy oil futures to create this narrative. Savon Henrik says as soon as inflation prints show signs of peaking and turning, rate high expectations will drop like a wet blanket. That's actually what I'm expecting to happen from March into April. I still think inflation is going to run hot for the next 3 months. Here's a look at crude oil inventories getting to dangerously low levels. Okay, so that's the key headlines I want to hit. Let's take a look at the bond markets. So this is the 2-year has now hit 1.35, signaling we have 5 rate hikes ahead. And this has driven the probability on the 50 basis point rate hike is currently at 26%. So very interesting CPI print coming in tomorrow. So we'll have to see how that comes out. Now, on the 30 year, you can see it's not going up nearly as much. So the yield curve is flattening, and this continues to become a problem. If we go over here, we can look at the 2 year spread against the 10 year. And this is what people use to predict recession 16 months ahead. And so typically the yield curve inverts, which means short duration debt pays a higher interest rate than long duration debt. And then it reverts and the long end rises rapidly and you get the big crash. And so we've seen this time and time and time again. At this point, we still have a cushion of 0.6% before we invert. So the short term inflation expectations need to cool off and the long term growth expectations need to rise for this trend to stop. And if we zoom in on it, we can see for the last year straight, we've had the 2 year rising and the 10 year staying relatively flat. And it is on the trajectory to invert. Now, again, that doesn't mean a stock crash right away, but typically predicts recession 16 months in advance. Now, if we jump to the yield curve, in this format, what we're looking at is the November 2021 yield curve compared to the current. And they're having no luck. We've got an inverted 20 and 30 year, which I don't make much of. The big problems for the market is this 2 year just can't stop going up while long-term rates remain flat. So essentially the market's saying that the Fed is behind the curve. We'll have to hike rates until it breaks everything. And so if we want to see what the banks want this to look like, we actually have to go all the way back to before they passed 3 trillion in new spending in October of 2022. We actually had a beautiful yield curve in green. So this is the shape they want, and this is the shape we have. So this is quickly becoming problematic. All right, let's look at some charts. First, we'll look at Boyle against NRGU. So Boyle is extremely volatile. The seasonality is to hit the lowest inventories into March. So that's actually when I would expect the risk of conflict, as Russia will know they'll have the most leverage at that point. So if we zoom in a little bit, we can see how correlated these are. And if oil continues to rise, I'd expect, which I expect it to do, unless there's some sort of significant event by governments to either shut down economies or somehow release more and more strategic reserves, which they've just done, and it didn't work for long. That I expect Boyle to leapfrog higher into the end of the month. Here's a look at lumber futures, which we had seen crash nearly 50%. It's been limit up for the last 5 trading days. Now, lumber futures had given us a warning that we were about to have a crash in oil 2 months early back in May. And I ignored that signal. Let me go ahead and overlay oil here. So we can see in May 21st, lumber futures topped and crashed. And then we were about to have a significant decline in oil of about 15%. Now, right here, lumber futures began to rise once again, and oil shortly followed after. So right now we have oil futures, copper futures, lumber futures, all pointing to higher energy costs. So Boyle had that run up last week. Wish we had cut it in half for sure, but now it's already cut itself in half, and we remain bullish, expecting that the fireworks are going to occur later in the month. Here's a look at copper futures going parabolic. If China is about to start increasing credit in their economy, they are the dominant buyer of copper. So again, every sign we have currently, even the Baltic Dry Index starting to pop back up after falling viciously from 5,600 to 1,500. This chart, we're looking at the NASDAQ, the candlestick. Yellow line are interest rates, and then we have NRGU in green. And what we're seeing globally, perhaps outside of China, is an end of mandates, which is highly uh, anti-energy and anti-economy. So looks like ahead of midterms, everybody's going to drop all of these rules. So I see the demand for oil going higher, and it's already an extremely political problem at these levels. So it'll be interesting to see what governments do to intervene. If I do zoom out a bit, here was that crash that lumber futures predicted in May, and ended up occurring for oil markets in June. So you can see that big sell-off here. And then we did the strategic reserve release, which created another sell-off, but that was also short-lived. So this is probably going to keep rising until the prices become so high that demand is crushed. This chart, we're looking at oil against interest rates, looking at the correlation, and they are married at the hip. We've had periods where they were not tracking one another, but since 2022, they've been highly, highly correlated. And so we're not getting any sort of discrepancy to predict up or down based on this. Now, we have had previous periods where rates remained far lower than oil costs. But at this point, they are tracking very, very closely. Now, we were expecting emerging markets to catch up to rates. This is something we did see that was off. We had interest rates rising, but emerging markets had remained behind the yellow line. And so today you can see emerging markets jumping and starting to catch up. And in general, I believe we're going to be in a multi-year rising rate period. I'm really only expecting a cool off in interest rates in the short term due to a lack of fiscal spending for now a year without new fiscal stimulus. We saw the same discrepancy between the Russell 2000 and rates. So I was expecting this would start to get a bid, and we're starting to see that. The Russell 2000 has gone out of its channel. Now we can see the rates were way lower for quite some time, and this stayed in its channel. So now it has broke below that following the rates, and it does seem to be following the interest rates back up at this point. Europe is another index that will do well in a rising interest rate environment, and same prediction and same outcome. We saw this discrepancy and it started to catch a bid. Now, again, in safe growth, you have Europe and Asia as a large portion of your portfolio. Here is the dollar index. Let me pull off the percent change. Was surprised to see this at 97.50, only to fall viciously back down to 95. Some people are asking when we would start to make trade alerts and significantly change the asset allocation. I'm actually looking at interest rates, CPI, and the dollar to make that call. And in general, I'm expecting to see DXY fall to 90 before finding a high level of support. And that's when we would do a pretty broad reallocation of capital and most likely bet on treasuries, the dollar once again. So this would likely mark much higher interest rates, much higher oil, and potentially a problem for markets. So we're still at 95 and have a long ways to go in that respect. Okay, in this chart, we're looking at the Chinese currency. We've got China and Russia making a pact to sell oil and natural gas in the euro instead of the dollar. And so slowly but surely, the the power and hegemony of the dollar is slowly losing power here. So we're watching some competing currencies, and so not a lot of action in the Chinese currency. We're also concerned with the real estate bubble in China and whether or not that could impact markets. And so far, it looks like they have contained that blow up of various real estate corporations that were extremely over leveraged. It does not look like a contagion to the rest of the market. This chart, we're looking at some of the leaders in the US stock market in the tech sector, and we were expecting that they would outperform as rates have been overdone and hyped up by the Federal Reserve. And so there you go. We've got just in the last few trading days, a 7% gain in Amazon, 5% in Nvidia, and then the rest of them are trading flat: Tesla, Apple, Microsoft, and Google. Now, with that said, we did see Netflix and Facebook blow up and lose about 25 to 30% of their market share in the last few weeks. So keeping a close eye on some sort of tech disaster. Other companies in the S&P 500 that we are tracking specifically are Bank of America, JP Morgan, and Berkshire Hathaway. And so we can see Berkshire Hathaway having a tremendous performance with interest rates rising up 17%. Now Bank of America and JP Morgan starting to sell off, perhaps predicting peak interest rates are in. And that would also coincide with this big melt up we're now seeing in Ethereum. Over in Asia, we follow and look for canaries in the coal mine with Taiwan Semiconductors, which has been ultra strong, probably the single most important company relative to a war with China invading Taiwan. Then we're looking at some leaders out of China, Tencent and Alibaba, which are down 35 and 55% from recent highs. If we're going to see a big outperformance in emerging markets, we absolutely need these two companies to stop crashing and start getting a big bid. And we are starting to see that stabilization and rise. Out of Europe, the company we track specifically is Toyota, and ultra strong, no signs of weakness there. So in general, the only main concerns that I have, and then also one last thing, the reverse repo we need to think of as a quantitative easing buffering, still at a very elevated level of $1.6 trillion. So we're still printing money through March. So we still got 2 more months of the Fed physically buying bonds. And then we still have 1.6 trillion in excess reserves parked at the reverse repo. So that's when I would expect interest rates to have significant risk of rising, is once the QE is completely ended and the reverse repo starts to drain. So we're not there yet. In fact, this just remains stubbornly and impressively at 1.6 trillion. So if we put this all together, what are we expecting? We're expecting the bond market crash to stop, essentially, and for growth to outperform. If I'm wrong, the energy is going to continue to lead the market higher. Interest rates are going to keep rising, and we're going to continue to see pain in tech. So that is really the two outcomes we're seeing. Now you can see the volatility in specifically stocks, but targeted at the NASDAQ, is definitely due to the sell-off in the bond market. And we can see the junk bond market down 4.5%, the TLT down 6%, and the investment grade bond market down 6.8%. So we are expecting this to now stabilize and either trade flat or up from here. And again, the only concern I would have is if the inflation is just much worse than we're all anticipating, and that it's going to keep rising for the next 3 to 6 months and not slow down. So tomorrow's print will be very important. This is the Tesla to Ethereum correlation. This was predicting Ethereum would have a big jump to catch up to Tesla, and that definitely has been happening very aggressively over the last 72 trading hours. We're getting a bid in gold and silver, keeping an eye. The last two big bull markets for gold were during rate hike cycles. So maybe there's finally going to be a bid for the old barbellic relic. We don't have this in our portfolios currently, as we have been preferring Bitcoin and Ethereum over gold and silver. So we'll keep a close eye on these assets to see if we should have some exposure. Now, when that dollar index gets towards 90, expect us to rotate a lot of money, probably out of energy primarily, but out of everything, and to stock up on some deflationary assets, which would be the dollar versus the euro with EUO. Treasuries, again, once we see that CPI really falling and rates peaking out, which I think is still a bit higher than we are currently, I'm going to get you big in treasuries with TMF, the dollar versus the euro with EUO, and then, of course, the VIX. Okay, we are currently long uranium and rare earth metals in the safe growth strategy as inflationary hedges with alternative energy strategies. So uranium for nuclear power, rare earth metals for batteries for tech giants. Okay, so those are getting a nice bid, up 10% and 8% to start out the month. Our boil, which had doubled on us, has pulled back, but again, I have been indicating we plan to hold that towards the end of February without exception, and that continues to be the plan. All right, now we're looking at the top companies in the cryptocurrency space right now. The safe growth strategy has a big Bitcoin position, and the high risk strategy has a big Ethereum position. Runners up are the stablecoin Tether. Then we have the Binance coin. Then we have USDC coin, Ripple, Cardano, Solana, Terra Luna, Avalanche, Polkadot. And then this one in our private equity fund, we've had a huge bet on, and this just raised $500 million, and it's had a huge, huge jump, 26%. Ethereum's getting ready to switch to proof of stake, and Polygon just raised $500 million. I do see potential risk to some of the competitors, specifically Cardano, Solana, Avalanche, and Polkadot. So it'll be very interesting to see how this all plays out as these upgrades come in. This chart, we're looking at the Dr. Copper, or the gold to copper ratio, and it is still predicting higher rates, especially with that big jump in copper prices overnight. The VIX term structure is not set up for a massive return in UVXY anytime soon. So we would want this to be a flat line or a downhill slant to anticipate immediate returns in UVXY. So just realize this would have to flatten and then tilt downward before we're going to get those extreme returns in UVXY. That product's very good at protecting us against massive crashes, not so good at small or slow pullbacks. And currently the biggest jump in price are in the front 2 months. Now we're looking at the returns from the recent bottom in some of our favorite cryptocurrencies. We can see Avalanche jumping up 47%, Polygon 35%, Ethereum 32%, Solana 28%, Bitcoin 26%, Polkadot, Binance, and Cardano 25%, 15%, and 13%. All right, here's that CPI that's coming out tomorrow morning. It's probably going to rise significantly. As long as it's below 6.1, I think the market has already priced in that we will have 5 rate hikes and the bond market won't get pissed off. If it's above 6.1, the bond market very well may sell off, anticipating very aggressive Fed hikes. And I'd anticipate this to be negatively impacting the tech sector. That said, we had rates rising and a big jump in crypto last week on a strong jobs report, which is unusual. Okay, the producer price index, we also need to see slow down. Here we're looking at the non-farm payrolls. All of these numbers got completely revised. Very, very suspicious. We could spend a whole hour just looking at how suspicious last Friday's labor report was. But in general, with mandates ending, I expect labor to grow and for this to slowly but surely put pressure on bond markets over time. Okay, here's the sticky wages, which jumped to a high last seen in April. So that's one of the sticky parts as well as rent. But we are seeing the cost of housing falling and mortgage rates rising. So perhaps another 6 to 12 months of sticky rent inflation before that peaks out. The labor force participation rate is starting to go to the upside. Now, pre-trend, we're still 3 million short of where we were before the lockdown. And had we continued the trend that we had with Trump, we're about 6 million jobs behind. So a lot of jobs still can come back on board here. Bank credit's growing rapidly as fiscal support is slowing. Very important. So is credit from consumers continues to grow. So no signs of a some sort of credit crash or spending crash dead ahead. Retail sales did fall slightly, um, but we've had a few negative prints only to be followed by positive prints. This remains very strong, and we can see consumer spending is at an all-time high. Balance of trade hit nearly a new negative record, and China's data just came in. China's come nowhere near buying all the goods they promised during the trade war. China's PMI falling month over month to 50, and we're starting to see signs China's getting ready to expand credit as the US is getting ready to tighten monetary policy and has slowed down new stimulus spending. Chinese exports and imports remain at record levels, slight pullback in imports, but a new high in exports. Between the two, they had a $6 trillion economy in the last print. US balance sheet continues to grow with all this hawkish talk. We're still printing money in the two most important central banks, the Federal Reserve and the European ECB. Okay, very good. So we're about to do a detailed analysis of our asset allocation. And again, if you're on a free trial, this is where your content ends. You need to upgrade and become a paid member so you don't miss the trade alerts and can learn exactly how to allocate funds. Call Dean now at 505-322-7515.